This video is brought to you by investing.com.
Well, what a turn of events. The man, the myth, the legend, Dr. Michael Burry, after going MIA for about 2.5 years, has returned to Twitter, and he has some things to say about the AI bubble that we're currently in. On October 31st, he tweeted, firstly, the iconic Big Short image of his character, but along with that, he said, quote, "Sometimes we see bubbles. Sometimes there is something to do about it. Sometimes the only winning move is not to play," effectively saying that in 2001 and 2008, he did something about it, but this time around, the winning move might just be to sit things out. This comes after Burry reported put option positions against Palantir and Nvidia at the end of Q3, which, while it's difficult to know for certain, likely haven't panned out for Burry, looking at the share prices for both these companies over the past few months. That was the first tweet, but now he's followed up with more information, this time explaining exactly the problem he's seeing in the big AI companies. Firstly, Exhibit A. In this image, Burry is pointing out that while the cloud segments of companies like Microsoft, Google, Amazon were showing pretty explosive growth across the 2018 to 2022 period, this is now slowing in the 2023 to 2025 period. But while organic growth is slowing, these companies are seeing their share prices exploding. Why? Well, in Exhibit B and C, Michael Burry is effectively calling out the AI Ponzi scheme, but instead of a pyramid, it's looking a little bit more circular this time, particularly between Oracle, Nvidia, and OpenAI. Oracle buys a heap of Nvidia chips, providing them with revenue. Then Nvidia agrees to invest in OpenAI, providing them with revenue. And then OpenAI pens a big deal with Oracle to give them revenue.
Speaking of money, how about the $20 you owe me?
Oh, yeah? Well, I only got 10, so here's 10 and I owe you 10.
Thanks.
Hey, Mo, you owe me 20.
Well, here's 10 and I'll owe you 10.
You owe me 20.
Here's 10, I owe you 10.
Here's the 10 I owe you.
Here's the 10 I owe you.
Here's the 10 I owe you. Good, now we're all even.
Now, sure, this looks impressive on paper, but Michael Burry is calling bullshit, and it's exactly these kinds of artificial, or some might say synthetic growth stories that give rise to big stock market bubbles. Synthetic growth is huge, but organic growth, real customers, real revenue just isn't there. So Burry is seeing some problems, but the market continues to rise with no signs of shakiness. In fact, over the past 5 years, the S&P 500 has risen over 90%. And this leads us to the question, okay, sure, the AI companies might be going absolutely bananas, but is the stock market itself runaway expensive? Is it so hot that we should instead be on the lookout for the next big short? And I want to start by looking at a very common metric used by Warren Buffett himself to judge the state of the stock market, and that is the Wilshire GDP figure. Buffett has previously said that the Wilshire GDP is probably the best single measure of where valuations stand at any given moment. And this is the metric that investors also like to call the Buffett indicator. So what does it do? Well, the Wilshire GDP measures the stock market's performance against the American economy. So the idea is that if the stock market rises way ahead of the economic output of America, you're probably in a bubble scenario. Specifically, the Wilshire GDP takes the Wilshire 5000 index, which is a total US stock market index, and divides it by the GDP of America, then multiplies the result by 100 to get a percentage. Now, generally speaking, a figure below 75, the market is deemed to be undervalued. At 75 to 90%, the market is fairly valued. At 90 to 115, 120%, we're looking at an overvalued stock market. And then above 120, that's where things really get into dangerous territory and the market is significantly overvalued. For example, at the peak of the dot-com bubble, the Wilshire GDP was at 138%, a really, really high valuation. But where are we today? Well, we might need a drum roll for this one. Get ready for this. The Wilshire GDP is currently around 220%, the highest it has ever been. As you can see, it did drop down to about 140% through 2022 as stocks fell. But yeah, according to the Buffett indicator, we're pretty off the chart at the moment. Now, to be fair, there are some factors that have reduced the reliability of this metric over time. For example, one big one is that many of these massive US companies generate a large portion of their revenue overseas. Now, the problem here is that US GDP only measures domestic economic output, while market capitalization obviously factors in earnings regardless of where they're generated. For example, in 2023, actually 28% of the S&P 500's revenues came from overseas, which is quite significant. Although even if we were very crude and we just reduced the Wilshire 5000 by 30%, we'd still get a Wilshire GDP around 157%, which still falls into that significantly overvalued territory. So that's the Buffett indicator telling us that yes, the stock market today is basically more expensive than it has ever been. But there's another really interesting indicator I want to go through next, actually developed by a Nobel Prize winner. But before we do, I know a lot of you guys are very interested in the platforms and investing tools that I use, not only for my videos, but also just for my general investing process. And I want to give investing.com a big shout out for their Investing Pro subscription. And I also want to tell you guys that they're currently having a massive Black Friday sale. This is the inside of my Investing Pro account. As you can see, it's such an easy way to track your watch list and specifically track the fair values being put on these companies by both analysts and investing.com's algorithm. In the ideas tab, you can also follow gurus like Buffett, Dalio, Klarman, etc. And I also want to shout out ProPix AI, which compiles different portfolios based on investing themes, and it tracks them over time. For example, top value stocks, best of Buffett, or even financial fortresses. Beyond that, they also have Warren AI, which is extremely helpful for when it comes to doing investing research. For example, it's even helped me to do some research for this video, telling me about the Wilshire GDP and how it's currently flashing a big caution light at the moment. And if you think investing.com is something you would be interested in, they are currently running their special Black Friday sale. So if you'd be interested in scoring a massive discount on Investing Pro, check out their discount. But the best bit is that on top of their Black Friday pricing, if you use my referral link in the description or pinned comment or scan the QR code on screen, you will get an additional 15% off. So please check it out if you're interested, and thanks to investing.com for sponsoring the channel and supporting what we're doing here. But back to that second valuation metric. The number we have to talk about next is called the Shiller PE ratio. This was created by Dr. Robert Shiller, who won a Nobel Prize in economics for effectively disproving efficient market theory, and instead he figured out that a lot of the price movements of assets come down to human behavior and emotion. Now, the Shiller PE ratio kind of builds on that idea because it compares the S&P 500 index to its average inflation-adjusted earnings over the past 10 years. So it's a big PE ratio for the S&P 500, but it strips out the effect of inflation and it keeps things conservative and smooth by looking at the average earnings of the past 10 years. So if you get a wild Shiller PE value of like 10 or 50, that's not a random outlier. It really means what it means. Now, historically, the Shiller PE averages out at 17, meaning investors are typically willing to pay 17 times the average 10-year earnings of the S&P 500 to own it. So assuming there's no growth, you will make back your money in 17 years. Today, however, investors are paying 41 times the average 10-year earnings of the S&P 500. And yes, that is the second highest value in history. It was only 31 in 1929. It was 44 before the tech bubble burst, and it was at 38 in the 2021 rally, and now it's at 41. So kind of crazy. Honestly, the more I look at the market today, the more it looks like 1999, literally a tech bubble 2.0. But what does the Shiller PE really tell us? Well, primarily, it tells us that investors are simply expecting lots of growth. They're paying a very high PE, so they're paying a high price today for where the earnings are right now. And that just means that they expect the earnings to play catch up over the next few years. And that's really the core of Michael Burry's point. From his perspective, he actually sees things going the other direction. According to the chart he posted, the growth in the cloud segments of these large AI companies is slowing, but investors are already placing their bets. The Magnificent Seven have seen huge inflows over the past few years, and this means they continue to take up a larger and larger percentage of the S&P 500 index. And as their PE values rise, so does the PE of the entire market. What does that mean? It means investors are expecting these AI companies to grow profits in a big way over the next few years, as this will increase the denominator and normalize the valuation. But if they can't, that's a big problem, and that's what Michael Burry is hinting at. That's the big takeaway from this conversation around these valuation metrics. To be clear, they don't predict downturns. The fact that they're high doesn't mean the stock market will crash next week. It's much more of a measure of expectation. What do investors expect over the next few years? And investors expect big growth in earnings. But this puts rational long-term investors in a precarious position because these AI companies now have to really increase their earnings to justify the higher prices. If they fail to do so, then yeah, eventually the PE ratios will correct, but they will do so through the numerator, aka prices will fall. So what do? Well, the truth of the matter is nobody knows what will happen next. Whether the Mag 7 can continue their stunning growth stories, whether the market is too expensive for even the most optimistic of outcomes, nobody knows. And that's why value investors always invest from the bottom up as opposed to the top down. Bottom up investing is the process of looking at companies based on their own merit and investing based on their own strengths, as opposed to looking at the macroeconomic landscape and choosing what to do from that lens. We have to remember that when we entertain questions like, is the stock market really expensive? We're starting to drift away from that bottom-up analysis, and that's not really the Warren Buffett way. No matter what the conditions, the Warren Buffett way is that we look at companies that fit in our circle of competence, so we actually know what the heck we're looking at. For me, that's things like video game companies or social media companies, etc. Then from there, you analyze which ones have an intrinsic durable moat, so some sort of pricing power, the ability to raise prices and suffer no ill effects. Then we check the management team for skill and integrity. And then finally, we wait patiently for a fair price and a margin of safety. Think about Charlie Munger saying, the big money isn't in the buying and the selling, it's in the waiting. And while it's true that if our circle of competence is just the Magnificent Seven companies, you probably won't be finding much to nibble on right now. If you lean further into your circle of competence, if you turn over more stones, there are still opportunities out there. I said this in my last video, but I was literally talking to Phil Town in Atlanta about a month ago, and he was saying that he and his team have been seeing this frothiness in the market for the last 7 years. It's been super expensive for 7 years, but during that time, they've pretty reliably been able to find at least one good opportunity every single year. So it is harder at the current time, but it is by no means impossible. So that's what we have to think about going forward. But with that said, that is the lowdown on Michael Burry's latest tweet storm and a bit more flavor on the market's valuation overall. Thanks very much for watching. Please leave a like on the video if you did enjoy, and remember that investing.com have that mega Black Friday sale if you'd be interested in taking advantage of that too. Extra 15% off with my referral link as well. But with that said, thanks very much for watching, and I'll see you guys in the next video.